Hey everyone, today I'm going to break down accounts receivable for you. It's a fancy term, but really, it's just about the money customers owe a business. Think about this. You walk into a store and buy a coffee machine for $300. But instead of handing over the cash right away, you say, "I'll pay you in 30 days. That $300 becomes the store's accounts receivable. It's money they're expecting to get from you in the future. Now, why does this matter? Well, for businesses, this is super important because it tells them how much cash they can expect coming in soon. Imagine waiting on a big chunk of cash to pay your bills or buy more stock. That's where accounts receivable comes into play. It's like a promise of future money. You'll see accounts receivable listed on a company's balance sheet under current assets. Why there? Because the business expects to get paid within a short period, usually within a year. It's a quick cash flow indicator. It's also a sign of trust between the business and its customers. The business trusts that customers will pay up eventually, and it's tracking that trust on its balance sheet. So next time you hear accounts receivable, remember it's just the store's way of saying, "I'm expecting some money from customers soon." It's a key part of managing finances and keeping the business running smoothly. Alright, that's it for now. If you have any questions, drop them in the comments, and don't forget to like and subscribe for more easy-to-understand financial tips. Catch you later.